morning, doctor. My name is Tan Jaya and my matrix number is 29932X. So today I'm going to present my individual assignment, which is the effect of internal and external factor on the credit risk of Raymond James Financial Institution. So this study investigates how both bank-specific internal factor and macroeconomy external factor influence the credit risk of Raymond James Financial, one of the financial institutions in the US. Before discussing this study, let me briefly introduce this bank. This study focuses on Raymond James Financial, one of the leading diversified financial service company in the US. So the company provides a wide range of financial service, including wealth management, investment banking, asset management, and security trading and the lending activities. Since lending is one of its main business activity, managing credit risk is essential to ensure the bank remains financially stable and profitable. The main issue addressed in this study is credit risk. Credit risk is the possibility that borrowers fail to repay their loans. When this happens, non-performing loans increase, reducing the bank profitability and affecting its financial stability. Therefore, understanding the factor that influence credit risk is essential for banks to improve their risk management practice. Based on this issue, this study has three research objectives. First is to examine the impact of internal factor on credit risk. Second is to examine the impact of external macroeconomy factor on credit risk. Finally is to analyze the combined effect of both internal and external factor on credit risk. Moving on to the literature review, previous studies have shown that credit risk is one of the most important risks that faced by the financial institution. So according to the Tehulu and Olana, credit risk is commonly measured using the non-performing loan. A higher non-performing loan ratio indicates a higher level of credit risk because more borrowers are unable to repay their loan. So internal factors refer to the bank-specific characteristics such as average loan loss provision, liquidity risk, ROA, and bank size. So these factors are largely under the bank control and reflect its financial performance and risk management practice. External factors refer to the macroeconomic condition, including GDP growth, inflation, the yield curve, and money supply. According to Pilinkus in 2010, this variable influence the economic environment and borrower ability to repay their loan, which in turn affect the bank credit risk. Therefore, based on the previous literature, this study examines how both internal and external factors influence the credit risk of Raymond James Financial. So next, I will explain the methodology used in this study. This study used secondary data collected from the annual report of Raymond James Financial and macroeconomic data from the US. So this study covered a 10-year period from 2015 to 2024. So to analyze this data, I used the IBM SPSS statistic. So the first one, the descriptive statistics were used to summarize the data. Next, the Pearson correlation analysis were conducted to examine the relationship between the variables. And finally, the multilinear regression was used to determine the factor affecting credit risk. So to answer my first research objective, I developed model 1, which focus on the internal factor affecting credit risk. So this factor includes leverage, loan loss provision, liquidity risk, profitability, and the bank size. To answer my second research objective, I developed model 2, which examines the external macroeconomy factors such as GDP growth, inflation, the yield curve, money supply, interest rate, and exchange rate. So finally, to answer my third research objective, I developed model 3, which combines both internal and external factors. This model provides a more comprehensive analysis of the determinant of credit risk by considering both the bank's financial condition and the overall economic environment. Next, I will discuss the findings of this study. First is the descriptive statistic. Based on Model 3, which include both internal and external variables, the average credit risk of Raymond James Financial was 27.4%, while the average ROA was 2.09%, which indicating the bank maintain a stable profitability during the study period. Among all variables, loan loss provision and money supply show the greatest variation over the 10 years. This suggests that the bank adjusted its loan loss reserve and in response to changing economic conditions, while money supply fluctuated due to the change in the monetary policy, particularly during and after the COVID-19 pandemic. So next is the Pearson correlation analysis, show that the only risk security ratio and the yield curve has significant relation with the credit risk. RSEC has a moderate negative relationship with credit risk with a correlation coefficient of negative 0.567 and a p-value of 0.044. This suggests that change in the bank investment security are associated with the change in the credit risk. The yield curve has a moderate positive relationship with the credit risk, which with a correlation coefficient of 0.478 and a p-value of 0.081, indicating significant at the 10% level. On the other hand, variables such as ROI are not statistically significant, as their p-value are greater than 0.10. Next is the model summary. Among the three models, Model 3 has the highest adjusted R-square of 0.813. So this means that the approximately 81.3% of the variation in credit risk can be explained by the combination of internal and external factors. Therefore, Model 3 is the most powerful model in explaining the change in the credit risk. Moving on to the ANOVA result, none of the three regression models are statistically significant because all the p-values are greater than 0.05. Specifically, Model 1 has the p-value of 0.792, Model 2 has a p-value of 0.267, and the Model 3 has a p-value of 0.138. Although the models are not statistically significant, this is likely due to the small sample size of only 10 annual year observation, which reduces the statistical power of the analysis. Finally, for the regression coefficient analysis, Model 1 did not identify any statistically significant internal factor. So in the Model 2, the yield curve is the only variable that is significant at the 10% level. So a positive coefficient indicates that an increase in the yield curve is associated with the higher credit risk. So this may occur because change in the interest rate affect borrower repayment ability and increase the bank exposure to default risk. So in the Model 3, leverage is the only significant variable at the 10% level, and it has a negative coefficient. So this suggests that a stronger capital position helps the bank absorb potential losses and manage credit risk more effectively. So overall, although the most variables are not statistically significant, the findings suggest that both bank specific factors and macroeconomic conditions should be considered when managing a credit risk. Conclusion, this study examined the effect of internal and external factors on the credit risk of Raymond James Financial over the period from 2015 to 2024. So the findings indicate that both internal and external factors are important in understanding credit risk. Among the three regression models, Model 3 produced the highest explanatory power with an adjusted R-square of 0.813. So this suggests that combining both internal and external factors provide a better explanation of credit risk than using either group of factors alone. So although most variables were not statistically significant, the yield curve in Model 2 and leverage in Model 3 show that the most meaningful influence on credit risk. So these findings suggest that both the macroeconomic environment, the bank financial position should be considered in credit risk management. So based on this finding, I recommend that bank continuously monitor the macroeconomic indicator such as GDP growth, inflation, and yield curve, because change in economic condition can affect the borrower repayment ability. Banks should also maintain adequate capital and liquidity to absorb potential loss and strengthen the resilience during period of economic uncertainty. So in addition, improving credit assessment and continuous loan monitoring can help to reduce the risk of loan default. So that's all for me. Thank you.